Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
You know what? I'm doing super good today, Joe. And my big goal for the day is that I am going to make a pot roast.
Really?
Yeah, that's it. That's what
I'm on my way over then.
Yeah. Well, we are welcome to come. That would be awesome. I'm also going to be looking good for you because I'm getting my hair cut today.
Ooh.
Yeah. It's been a while. So looking forward. How about you? Did you, I think I'd noticed that you did get a haircut. You were looking pretty good there for a while.
I did. I finally got a haircut. I couldn't take it anymore. I was working out and my hair would get sweaty and it would flop against my face. And I had to get it chopped.
Well, that is a problem now, isn't it? Well, all right. Well, today we're going to kick it off with our friends that are going to solve all our problems. If you're a borrower, you're going to be happy. If you haven't already met Matt Flynn and Beth Johnson of Flynn Family Lending, today is your lucky day. These guys need to be, for every borrower, on direct dial, speed dial. They provide a fantastic solution where other lenders can't, fit the bill. And Flynn Family Lending is a local, we're here in the Seattle, Washington area in the Pacific Northwest. They are a local boutique private money lender. We've had Beth on our podcast before, podcast number 88, which we encourage you guys all to go back and listen to and learn about Beth and all the details on that one. We'll have Joe drop that into the show notes today as well. But what Flynn, man, I don't know you guys. You guys that must have like drinking games related to say Flynn Family Lending all the time. It's what these guys do is they're asset-based private money loans, including second position deeds of trust, as well as creative options such as cross-collateralization to increase a borrower's lending potential. So we're going to learn about that today. And in addition to loans for real estate transaction, they also specialize, in asset-based small business capital loans. And sometimes I don't think those get talked about enough because that's a very valuable service that you guys offer as well. So welcome, Matt and Beth.
Thank you, J&J, for giving us this time. This is awesome.
Yeah. Glad to have you guys back. We love you guys because you guys think outside the box, You're very personal touch. That's a bit unique. With some of the lenders that we have, some of our other friends, we also love, the personal touch that you guys offer makes it so everybody feels more comfortable and actually gets to learn a lot along the way. So let's jump into it. Today we want to learn about Matt as we kick it off. Like we said, we heard Beth's whole backstory on podcast number 88. And today we're going to kick it off learning a little bit more about Matt, and then we're going to jump in to some details and some juicy stuff about Flynn Family Lending. So let's do it.
Yeah, Matt. So we heard about Beth on podcast 88, like Julie said. So if you guys want to go back and hear that. But Matt, we'd love to hear your backstory, like where you grew up, how you grew up, and how you got into this crazy world of real estate and lending.
Well, thank you, and good morning, everybody. So a little background on myself. I'm a native of Washington. I was born and raised here in Bellevue, so I've been here all my life. I have been in the real estate or mortgage business for probably 20 plus years. I used to have a mortgage company with my brother back in the early 2000s. And we also kind of dabbled a little bit back in private money. And we did that for about 7 or 8 years. And then when 2008 came along, we shut that down. And I started working for Wells Fargo, and they gave me a pretty good gig there for a while. So I did a lot of mortgages through Wells Fargo, and I was with them for about almost 9 years. And during that period in the latter parts of the year, about 2014, 2015, I started getting clients who were looking for a little bit more creative financing rather than your traditional Fannie Freddie stuff. And so I started dabbling a little bit with them, helping them out a little bit on the side. And then the next thing I know, that business of private lending started organically taking off again, which was really cool. So I spoke to Beth about me taking that leap of faith and leaving that security of a banking job and pursuing private money again. And she said, go for it. And then about a year later, we were in cahoots together. So we both quit our jobs at Microsoft and Wells Fargo, and we started Flynn Family Lending, and the rest has been history.
Wow. Good stuff. And good for you to be working together so closely and, living your own dream there as far as controlling your own schedule. Although I don't know how you can control your schedule these days because you guys are so in demand that it's probably hard to get away from the office these days. But Matt, take us back even further. Like, how did you first, we like to know this fun part of this stuff before we get into all these things. Like, how did you get involved in, like, what made you, when you were young, or did your family, were they involved in banking or lending or real estate, or where'd you go to school and all that stuff to get you going on lending in the first place?
So I went to Newport High School, and then I went to Washington State University.
Yeah, baby.
When I graduated from college, I worked for Seafirst Bank as a teller. And so I did that for a little while, and then kind of dabbled in construction and odd jobs here and there. But how I really found my niche was I bought a condo here in Renton for $16,000 back in 1988. And to me, that was a lot of money. That was a tremendous amount of money. I sold my car. I got like $2,500 for it. Was able to buy this condo on a seller contract. Well, I had this condo for about 4 months, and I was able to sell it, and I got about almost $30,000 for it. I'm like, whoa, I am rich. And so I was able to take that money and buy a place on what's called Lake Sawyer, which is out in Four Corners, Kent area. And so I bought that on an owner contract too. I was like, wow, this is pretty cool stuff. Well, I had this house for a couple of years, and then one of the problems with the house was it wasn't a very nice house, but it was good for me. The heating system went out, and so I'm like, oh, crap. So my roommate and I, we only had a styrofoam cooler. It was pretty rough times, and a wood-burning stove for heat. So the stove went out, so we tried to fix it, and that didn't go so well. So we started putting in the new electrical system to try to update the property. The next thing I know is as I have all the floors and walls open, I'm putting new electrical in, then new flooring, and started remodeling the house myself. After a little while, I ended up remodeling the house, and it came out to be a pretty nice place. But the problem was one day the seller who was carrying the contract came to visit me. And she said, hey, I love what you did with the house. I said, thank you. I put a lot of time and effort into this thing. She's like, well, it's great, but the problem is in my contract that I had with her, I had to ask permission to do any upgrades or remodeling to the property. Otherwise, my note became due. I'm like, oh, I did not know that stuff. And so she's like, yep. So she called the note due. I'm like, oh, crap. Well, I owed like $100,000. So what's the first thing I did? I went to my local bank where I worked and said, hey, I need to get a loan. They said, you don't make enough. You don't qualify. I'm like, oh, crap. So now what do I do? So here I got this house now that's worth probably $200,000. I owe $100,000 on it. And the bank said no. I'm like, oh, what am I going to do? So as a young guy, what did I do? I went to mom and dad. I said, hey, mom, dad, I'm in a big pickle here. I'm going to lose my house. And I need $100,000. They're like, okay, so what are you going to give us? And, for security and all these kind of things. So I said, okay, I'll give you my house. My dad said, okay, I'll tell you what. I'll lend you the money at 12% and 10 points for 1 year. I'm like, great. I don't know what that means, but does that mean I get to keep my house? He goes, yep. I said, okay. So we wrote it up. My dad had an attorney actually draft it up. And, I got to pay off my seller contract, but I didn't really know what I was doing. I didn't know what points were. I understood interest rates a little bit, but I didn't know all these things. So I didn't realize I was paying $10,000, but I just know I got to keep my house. So then I was able to refinance with my dad, paid off the seller contract. But now I'm thinking, oh my God, my payments almost doubled now. I got to figure out a way to do some damage control. So back in the early 90s, remember how people used to get all these credit card offers? So I started looking at all these credit card offers, 0% interest rate. So I started applying for these credit cards at 0%. And so what I would do is borrow money on the credit card at 0%, pay my dad back, and then, I'd get another credit card, pay off that credit card, rinse and repeat. Well, the next thing I know, I had about $250,000 in credit cards where I would just every month buy one credit card, 0%, transfer it over, pay off the other card. So literally I was paying 0% interest rate on the money I was borrowing to make my house payments. So I learned how to use OPM, right? Other people's money.
Yep.
Kind of how I learned about private money was where can I borrow money at 1% to pay off another debt? And so that's how I kind of got started with learning how to use other people's money. And so I did that for a while. And then in 2000, I did that for about 4 or 5 years. And then my brother and I started working together doing private money and mortgages. And so we did that for about 8 or 9 years together. And it was awesome. We had a great experience. But then when 2008 came, we were a little bit over leveraged. So it became very expensive because a lot of these notes that we were doing were kind of highly, the leverage on it was around 80 or 90% because we kept thinking the market was going to go on forever, right? Back in the days when we used to take applications, those 80-20 loans, fog and mirror, we thought everybody would get a loan. So when we were doing these owner contracts, it just seemed organically like this was never going to end. Well, then 2008 came and that was a game changer, as we all know, right? So a lot of our notes became worthless because the loan to values were too high. So it was a learning experience for us. So moving forward, I was at the bank, like I said, for a while, started dabbling back in private notes again in 2013, 2014. And, we've learned a lot from our previous experiences. And now we're a little bit more conservative, but it's a better way to protect our investors and our clients and the borrowers. And so we've used that matrix or that experience to help us learn from our past mistakes so we don't do that again.
Right on. Right. I got to say one thing. Your dad seems pretty savvy back in the day, right?
He did some small private notes on the side. He was a pilot, so he had found himself when he wasn't in the air with lots of time on his hands. So he rehabbed houses. He built some houses in Newport Hills where they lived and did private notes on the side. So Matt got a taste of it pretty early on.
That is a good story.
I just knew what he did, but I was never in the grassroots of what he was really doing at the time. So it was an eye-opening experience for sure.
How did you know or about the seller financing did you ask for it or were they just offering it and you were like, what's that? That sounds good. Or, talk about starting off the right way, right? With seller financing, I guess.
Right. So I started talking to a couple of friends, who own properties, and it was actually a condominium right down the street where I actually live now. And I knew 3 people that lived in this condominium complex. And so I always told them, hey, if you know anybody who wants to sell a condo that would be, open to some owner financing, because I can't go to a bank, if they would help me out, I would love to, try to buy a property. And one of my friends said, hey, my neighbor's looking at selling his unit. And so he introduced me to the guy, and I said, hey, I can't get a loan from a bank. I just got out of school, but I can give you a nice down payment if you'll help me out. And so we talked about it. He said, yeah, I'd be open to that. And so, the rest is history from there. So we wrote up a contract, and he carried the note for me. And, so it was just basically asking people in the complex if they're open to selling our property. If they were, call me and let's see how we can, put pen to paper. And it worked out. You never know unless you ask, right?
You never know unless you ask. And even if you think your terms are crazy, you still never know what people will agree to, right?
Yeah.
So you guys that are listening here, this is why we love Matt and Beth, because they've been there, done that, right? They understand. They're not just working in their business. They've participated in this type of creative financing and lending for their own portfolio, their own purchases and stuff like that. So, like we said, I think it says on your website, their creative approach allows them to cater a loan to meet a borrower's individual needs, where other lenders may fall short, right? I mean, you guys have experience through the ups and the downs and know when to, even experiencing the over leveraging, back in 2008. What a great lesson to set you up for a long-term success with your own business now, knowing to be careful with that. And I'll just say, you guys that are listening out here, by the end of this podcast today, some of you may even want to talk to Matt and Beth about how you can become a private money lender yourself and work with them to earn great returns on your own idle funds. Or maybe you're tired of being a landlord and all the hassles of being a landlord, and you're looking for an alternative way to earn passive income. Stay tuned, and you might learn how you can become a private lender yourself and work with Matt and Beth. So, well, let's get to it. So, guys, what has the last few months been like for you during our current health crisis, and how everything's impacted our economy and unemployment? And how is your own lending business, Flynn Family Lending, how's that been affected?
From a lending side, we've been quite busy. I mean, in March, when everything kind of hit the brakes, our calls were coming in. Matt's phone wouldn't stop ringing off the hook because people were trying to save their deals. A lot of capital markets froze up, weren't buying loans anymore. And then that cut our competition down by probably over half. But that means that we had to really vet out each deal because of the uncertainty of the market ahead and how the stock market crash or the unemployment and the quarantine was going to affect the real estate market locally. So there was a lot of uncertainty and moments of pause on our part, but phones have still been ringing off the hook. And if the deal makes sense, which is great for us because we were conservative prior to COVID, they'll still make sense to us now. So our practices haven't changed a whole lot because we were always slightly more conservative than our competition, or co-opetition, I like to say, since we like to work with a lot of other hard money lenders in the area too. So we've been quite busy. And on a personal stance, all of our rentals, because we own over 40 doors in Washington State, all paying on time since March. So we've only suffered maybe a couple of $100 of loss in rents over the last month or two, where we're giving some concessions to one of our tenants, but market looks good to us.
Right. I was gonna say that it seems like everybody in general is faring pretty well with their rentals up to this point. I don't know if that's being propped up by probably some unemployment checks and stimulus money. And so, who knows who has a crystal ball of what's going to happen in the future. So have you guys, you were already, like you said, you learned your lesson long ago back in 2008 to be conservative. And so what does, a little bit more conservative mean exactly to you guys?
So going back to, mistakes I've made in the past and working with Beth, we've learned that, by being a little bit more conservative up front, it does save a lot of challenges down the road. And so by keeping our LTVs and our leverage in a position where we have a lot more security maybe than most, it makes it so not only is our investor protected, but also we're making sure that the borrower always has an exit strategy in play. So it's not always about lending the money, but it's also making sure that the borrower has a good, solid exit strategy. And that's important too. So we just want to make sure that any deal that we look at or fund, you go from A to Z. A lot of people just look at the deal, but they don't look at the terms or their exit strategy. So we always make them dig a little bit deeper, and we try to educate people on these things to look out for, because once we get the loan, if there's a shift in the market or something changes, we just want to make sure we're prepared for it so we're not caught off guard. So I think a lot of borrowers and investors do appreciate the little extra more white glove that we give. So we're pretty proud of that. So we're still batting 1,000, which again, we're pretty proud of that.
Well, and our loan to values were typically around 65 to 70% loan to value. It provided a little extra cushion, as Matt said, that he didn't have in 2008. So we're learning lessons. And then we balance that out with some other more complex and higher risk in different areas, right? So we'll take on cross collateralizations, or we'll do second position loans, which are generally a little bit more risky. But if we keep our combined loan to value lower, then we're still in a pretty decent place. And one of our exit strategies before COVID was always, well, if they had to, they could go to one of the more aggressive hard money lenders and refi out of our loan. And now post-COVID, that makes exit strategies even tighter, because all of our competition have lowered their loan to values to about where we're at too.
Right.
On average, 65, 70% loan to values. We've seen long-term rental loan programs halt. There's just a few in place, and conventional financing even more difficult, that are requiring lower loan to values and larger cash reserve requirements. And so that's kind of slimmed out, additional exit strategies that we have to make sure are there.
Exactly. How does your loan terms, I was going to go down kind of a pecking order here, but we're going with the flow. How do loan terms, what are your loan, as far as, the length of the loan, does that impact things, or have you had to be more flexible, to help people ride things out with longer loan terms, or any changes there?
No, most of our loans are usually around 10 months. We kind of like that 10-month number because it helps clients with, either loan seasoning, or they're going to refinance, or, make it so the banks will go off the appraised value rather than acquisition price. But we kind of like that 10 months speed bump. That way, if the clients make payments on time, if they need extensions, absolutely. But it also helps us. So if we have a client who's a little more of a challenge, then, at the end of the 10 months, we can look at an exit strategy knowing that one's already in place, and we can kind of move on. So it just makes it so our investors and our borrowers are in a good position during the 10-month period. And that way, if there's any changes in the market or whatever is in the future happens, then we're prepared for it.
So what does a loan application and approval look like with you guys, and how does that differ from anybody else? Is it standard for everybody, or are you guys a little more flexible? Is it easier going?
I would say it's a little easier going because we're more asset driven and we're local. We have a lot more autonomy and control, not only over our own funds, but our underwriting decisions, which you might not get when you go to one of the larger lenders and you're reliant on them to, the AE to pass on your loan information to an underwriting team for approval. When you call Matt, you get the key decision maker on the phone. And we're a small team, so we're all sitting in the same office and making decisions together. Online application through our website, it's pretty simple, takes less than 10 minutes. And because we don't necessarily publish exact loan programs per se, it allows us that flexibility to take each deal, each borrower, each project on its own merit.
Yeah, and I think that's what makes you guys somewhat unique, is like Matt was talking about, is this hands-on approach. It's almost like, in some ways, for people who are maybe less experienced, or probably even for those that are overconfident and more experienced, getting your perspective of making sure that all the exit strategies are covered or discussed, and having more of a teammate rather than a loan processor is, how it sounds like it is when you work with Flynn Family Lending, that one-on-one approach. And so you guys are doing fix and flips and commercial loans, construction loans, land loans. Is that right? And of course, some business capital loans as well.
I think we've kind of slowed down a little bit on construction loans and land-only loans, although we have helped clients purchase land but cross-collateralized it with existing real estate. We always like to see some sort of structure on there now, just because in an uncertain market like this, the asset classes that are going to be punished first are probably your super high-end residential and your commercial and your land. And of course, the speculative construction deals. So we're a lot more conservative. It's not like we haven't done them, but a lot of people aren't necessarily coming to us seeking that because they kind of know, and they've gotten told no so often that, construction loans are far and few between. So they've kind of stopped asking, I think.
Yep.
Right. Yeah, exactly. When you guys are doing like your fix and flips or anything like that, what's your, I'm going to just go down the pecking order here just so everybody gets an idea. What's your draw system like? What do you guys require for draws and things?
Regarding the draw system, we try to keep it pretty simplified. Whereas, we ask for pro forma, what's their budget, and we really work with the borrower just to get them to the finish line. So we like to do the draw system and, maybe 2 draws or 3 draws if possible. So we do ask the borrower to be pretty proactive, work with the builder, so once we have pro forma, we'll just pick up milestones and say, once this milestone is done, we'll just either do a site visit or ask the borrower just to FaceTime us so we can see that the project's done. If it looks good, then we'll wire the funds to the borrower. The borrower can pay the contractor, and that way the borrower is involved in the process as well. So we like to keep the borrower pretty proactive in the whole or participating pretty proactively on the construction.
And no, we don't want to handcuff, right? And so Matt's talking about construction. We haven't done that in a little while, but for, cosmetic fix and flips, we'll probably only do maybe 1 holdback just to see them put their own funds to use and make sure that the project is progressing along. And then we'll release the remainder of the funds. No receipts required, no invoices. We don't have expensive construction draw fees because we don't have to work with a third party construction draw company like some of the other hard money lenders do. We just do it all in-house.
Awesome. So is each loan is you guys are, the loans are actually done by private money lenders, right? How does it work? I mean, are you lending some of your own funds sometimes, but you're also working with investors who want to loan there. How does that work?
We started out with just a couple of different investors that Matt had worked with prior to 2008, and they were seeking to get back into the business so they could earn double-digit returns. We, of course, use some of our own money as well. And so we have this growing pool of mostly real estate investors, although some of them are just W-2s looking for a safe place to put their money with some security. And so we don't really advertise a whole lot, but we've got local investors who are, maybe older landlords, as you mentioned earlier in the call, of people wanting to get out of fixing toilets and such, and they understand real estate, so they like investing through us. And then we have some younger investors who, again, have small families. Maybe they're working dual income and they want to diversify their portfolio outside of stock market. So they don't really have time to get into fix and flips, or not sure if they really want to manage a rental, but dabbling in private notes seems to be, a solid way for them to invest and earn double-digit returns without a whole lot of active involvement.
We've also had several clients who originally started out as borrowers are now our investors because they love the idea of how our process works. So they know that we are a little more conservative. We always make sure that it's a win-win deal for everybody. So we, like I said, I don't know how many clients we've had that originally started out as borrowers. Now they're our investors, and it's been a great experience.
Exactly. That's what I'm talking about here, guys. Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, burr investing, flipping, multifamily or commercial coaching, whatever you like. we've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. And so what do you think? I know you guys, we're going to get into what it means, a second deed of trust and how those are used in your business there. But what's for somebody who's like, wow, that sounds great to me. What would be a minimum that you think somebody would need to invest to become a private investor?
Usually it's around the 50,000 mark, although we have gone a little bit lower because we deal with whole note investing, which means that we assign you to one specific loan where you're individually named on the loan. You don't necessarily have to be an accredited investor who would have to be qualified in order to invest into a mortgage fund or a pooled fund. Since we don't pool our capital together, it makes it easier. Although I will say that with loans of that size, maybe sub 100K, it might take a little bit longer to get placed into a loan. And when you go below 50,000, it just doesn't financially make sense all the time for the borrower, just because we have some fixed costs. And when you get down that low, there's usually a fixed origination fee as opposed to points. And so that can sometimes make it cost prohibitive. And usually you're looking at around 50K to 75. That's usually in second position behind a traditional mortgage. And so that adds a little bit more risk to it, but it's definitely doable.
Well, let's transition into that, talking about second position, second deeds of trust. Not a lot of lenders offer that. You guys have done a great job. I don't want to put words in your mouth specializing in that, or you can describe it yourself, but let's talk about how you guys use second deeds of trust, what that means, and fill us in.
So we like second position loans as long as the combined loan to value, which is that combination of the first and our second loan to value, doesn't exceed 65%. But the first has to be with a traditional lender like a Wells Fargo, Chase, right? One of the big fives. We won't really do a second if it's behind a private note, just because of the terms of the first. So the majority of the time it is behind a traditional first lender. We like that because if you can get a first mortgage at 5% and then we can come into second at 11 or 12, then it doesn't hurt as much to have a combination of a first mortgage at 4 or 5%. Then we can do a nice bridge loan second to help them get them over the finish line. Because normally our seconds are for assistance with down payment or rehab or whatever their challenge may be. So if we can get a nice low interest rate first to do a majority of the weightlifting, we like that aspect. So we're very open to those things.
And so we're talking about going behind a conventional, do those first position loans through those traditional banks and so forth allow seconds, or how does that, do you have to read the note, or how does that work?
Not on Fannie Freddie. You're allowed to do seconds or bridge loans behind Fannie Freddie loans. The challenge is when you get behind private lenders, there are some private lenders do not allow it, or you have to ask for permission first. So it's okay to do a second behind a traditional loan. It's actually some private lenders don't allow you unless you ask or get permission. So that's why we usually shy away from most private first.
And it becomes punitive too, right? Yeah. A bank, if you go into default, isn't going to have a whole lot of exorbitant fees or penalties. But when you go behind a hard money loan, again, that's really deemed as a bridge loan. So the terms are a lot shorter. It's not 30 years and fixed. And there could be some punitive, balloon payment penalties, or default interest could go up significantly. And that could squeak us out of our equity buffer, right? So that's one reason why we tend to shy away from that. Although we've done it in the past, and we've done it behind seller financing, or we've worked with the seller to subordinate to us so we could go into first and helped the client negotiate that. So
let's jump on that for a second. I'm telling people. So if you get in a situation, which we all hope that you do, where you are able to get some seller financing, you can also request that seller who's giving you the seller financing, that they go into second position, right?
Correct.
And so, I don't think, and people don't always think about that, right? That they can ask the seller to go into second position as well. That means maybe, that might allow you guys to step into first at sometimes. Can you give us an example? Do you have any, like a little quick case study on second deed of trust, or what you see people using those for most commonly, or how?
Gosh, most recently we did a business seed capital loan for a guy who owns a rental property in Everett. He actually works in commercial fisheries up in Alaska, and he was looking to get a trawling license or something of that nature. And so he was just looking for a small $40K loan. That doesn't happen all the time, but he was looking to pay it off with the revenue that he would generate at the end of the fishing season. We've helped other clients take out business seed capital loans in second position. Locally here, we had some clients who were looking to buy out their business partner for a marine services company located at the south end of Lake Washington. They have two rentals. One's in Seattle as a condo, and the other was also a single family residence in Snohomish County. And we did a second lien position loan on both of those properties. So we cross collateralized them. And we also did a UCC lien on the new business that they owned. And that loan was for over $400,000. And so they were able to successfully buy out their business partner, who they had some disagreements on operations. And so they just wanted to buy them out early. And they just recently paid us off in full. So that was a really great situation for us and them, knowing that they had only been in business for, I think, less than a year. So they didn't at that point qualify for an SBA loan. It made sense to use us as a bridge to get to that SBA loan eventually. And they were able to get it. They operate a very successful marine services business on Lake Union near us.
That's a good story. That's a good story. So let's jump into what that means, of how cross-collateralizing, what that means, and how that works with seconds. And, because I think what you just described is that you use that marine services business owner's real estate property they own to secure your loan for their business. Is that right?
That's correct. So they have pretty good equity in their rental properties, and also the goal of a startup business, which they were really walking into, was to keep the cash in hand and let their equity work for them. So by them using their equity and their rental properties, they didn't have to put a huge down payment down on this business. They were able to keep a majority in their funds in reserves, which banks like to see, use their equity in their rental property to secure our loan. And that way they were able to do a nice refinance and have plenty of money and reserves in their bank account, which banks like to see. And now they're making their asset work for them. So it's a good story.
Yeah. Let me ask you, so what if somebody owns rental property, but they own it in a partnership? Let's say they own, 20% of a property that's a bigger property, and, they have that, the partnership has equity. Is that something that can be tapped into, or it needs to be not in a partnership situation like that?
Well, it can be in a partnership, but both, all the members would need to acknowledge and agree to the loan. So we just did one last week where there are the two business partners on the LLC, and she owned a property. Actually, they owned it together in the LLC, a flip in Everett. And then she owned a single family rental in Renton. And so we cross collateralized both of them in second position. we pulled out around 160,000. She had quite a bit of equity in both, and they used that for a down payment on a bank-owned property that they were in contract on in Puyallup. And so, as long as both of them were willing to acknowledge the deed of trust and put that up as collateral, we were then able to put both of them as the borrowers, and they were in agreement on it, and we were okay with it too.
That's good stuff. How about if somebody? How about if somebody? Do you allow this? I guess I would say. Let's say you've got somebody that's an active investor, and they wanted to borrow some private money and just roll it forward, almost like a substitution of collateral clause, where you've got like a private money lender that wants to keep earning some great money, and you've got an experienced investor. Do you need to close it out every time, or can you use some sort of clause like that?
See that again? I'm sorry. I don't really understand that part.
Oh, I guess I'm saying, so when you have, let's say you've got a loan that out to somebody, or one of your lenders has, or private money lenders has a loan out to somebody, and rather than pay off that loan, maybe the deal is coming to a close, that the loan would allow for a substitution of collateral where you just go move on and attach to a new property instead of having to, redo the whole loan over again. I don't know, I'm speaking in layman's terms here.
We could do that, if we have to do a partial recon. Let's say that we cross-collateralize a couple properties and they end up selling one. We can do a partial recon, and they, sometimes they don't even have to pay us off in full. Let's say that we do a cross-collateralization and, they're going to get X amount of dollars. Well, as long as they keep our loan to value and our security at our matrix, we'll be fine. So they could sell a property, keep some funds. And, if they want to use a partial percentage of that to pay down our mortgage, that'd be great. So we can always have those kind of conversations. Or if they want to substitute one property with another, again, as long as it meets our matrix, we're okay with that. So we're always open to creative ideas and whatever it takes to help get the borrower and to the finish line and keep our investors safe. We're more than open to any of those kind of opportunities. So whatever it takes to make the deal work, we're definitely open to that. Again, the nice thing is because our investors are all local and they all have a little bit of real estate experience, we can all work together to see, what works, what doesn't work, which is really nice. So having our team local here, having our investors local here, our attorney here is local, it just makes things very simple and very smooth. So not a lot of hurdles if everything makes sense, or if it doesn't, let's just figure it out and let's see how we can make it work.
And so is there any collateral aside from real estate that you guys are able to use? I mean, I love the idea that, whoever owns property, if you haven't done this in a while, you should put together your schedule of real estate and assess, how much equity you have in your properties, because that is just sitting there ripe for you to use to buy more property, right?
Yeah.
Yes, absolutely.
We do that all the time. We have a lot of clients now because people are starting to learn how to use their equity, because I don't know how many conversations we have with people, and people love to talk about their equity position, right? Then when you ask them, well, what are you doing with it? That's when you get the deer eyes. So that's why we talk to all of our clients and say, hey, look, if you like, send us your schedule of real estate, and we can tell you how much money we can give you using your portfolio as collateral, so you can go out and expand your business or expand your real estate holdings. Make your equity work for you. Don't just let it sit there stagnant. Make it work for you, because you worked hard for that money. Now it's time for your money to work hard for you.
Exactly. Is there any other types of forms of collateral other than real estate that you can use?
Well, like I said, we did UCC liens. So we've done several small business seed capital loans for restaurateurs. And they'll put up their rental property, or sometimes it's an owner-occupied business purpose loan. But they'll put up their property as collateral, and then we'll also do what is a UCC lien, which is placing a lien against their business. Now, that only makes sense when there's actual assets associated with the business. So with a restaurant, then it does make sense. They've got a lot of equipment or revenue that could be garnished. With your normal general contractor or sole prop business, that doesn't necessarily make sense for us, but we've done UCC liens on businesses in the past. Other collateral types outside of that, not necessarily, although Matt's been approached for putting liens against boats, Rolls-Royce. Rolls-Royce. Those haven't always really played out. They don't actually want to give you the keys. They don't want to give you the keys or the title, which kind of doesn't really help.
But we all to those.
Well, I imagine there's sometimes also where borrowers can actually qualify for conventional financing or other financing, but they have timing issues, like they haven't filed their tax return yet or something like that. And are you guys able to step in? That could happen. Like you could be completely qualified and, have some sort of, you can't check the box for some reason and you guys can step in and gap that.
Yeah, you bet. And especially for value add properties or BRRRRs, particularly with commercial properties, why go through the time and the expense to get a commercial appraisal done? And that's usually, 6 to 8 weeks out and can cost you anywhere from $2,500 to $5,000 plus, knowing that you're going to make improvements and then have to refinance out of it and pay for another appraisal when you're completed. And so it makes sense to get that hard money loan or private money loan with us so that you can close it quickly, make your improvements, and then refinance out conventionally once you have it, the space rented out.
Right. Absolutely. And how about working with people's self-directed IRAs? Are you able to work within that?
Well, we have quite a few of investors that lend out their self-directed IRA funds to, notes, borrower loans. We haven't had too many clients that actually purchase properties in their solo 401ks or their self-directed IRAs, although we have done it on a case-by-case basis because that self-directed IRA does require it to be a non-recourse loan, which we don't typically do.
Got it. That makes sense. So you guys are investors yourselves. What's your investment plan these days with everything going on? Are you still buying, taking a break, waiting for maybe see what happens next year?
No, we purchased a couple properties. We bought a 5-plex about, 4 or 5 months ago. We bought a 4-plex back in January. So we still like multifamily.
We each bought our own properties in March. Matt got a 4-plex and I got a triplex with a friend of mine.
Yeah. So we still like the market.
That sounds better to me than she got a Mercedes and you got a Lambo. That I like the 4-plex.
He tried to one up me, Julie. I was going in on a property. It was like
size does matter.
It was kind of a retail purchase, but dabble in the Spokane market with a friend of mine who grew up there, and her dad is our feet on the street there. He's a real estate agent, so it made sense. And then he got a little jealous and went out and bought his own 4-plex.
There you go. Yeah. Good stuff. Now, when you guys are buying your own properties, are you pursuing seller financing or if it's available, you go for it? Or are you just aiming for that all the time or what?
Actually, we used our private investors' money. So we put a down payment down and spoke with our clients, and they actually helped us out. And then now we're in the process with a conventional lender to refinance these properties now that we got that 6-month seasoning taken care of. So now we're working with our conventional lenders to help us refinance it into a longer term loan. And so not only do we lend money, but we also have borrowed money from our own clients. So, I mean, it's not always the price that dictates the transaction. It's the terms, right? So we're just using private money to get us the keys. Now that we got the keys, we were able to go into these units, fix them up, make them pretty nice. And now we got that 6-month seasoning where now we can refinance it off the appraised value, not the acquisition price. And so now we can refinance as a rate and term, not a cash out. So actually now we're getting better terms. Because as you know, when you go to a bank, If you want a cash out loan, it's a little bit more expensive. Where now we've used private money, and now it's a rate and term loan. So we're actually saving a little bit on our refi as well. So planning ahead, thinking of these things can benefit you quite a bit.
Right. Knowing all this, go planning it going in. So for those who aren't sure what you're meaning when you're talking about the seasoning, tell everybody what you're talking about there.
Well, a lot of banks like to see, a seasoning. They want to see, especially on multifamily, they want to see a rent roll, or they want to see that you have ability to manage the property, or they want to see what the property revenue is. So by us going into the property using private funds, we can go in there now, do a little rehab, maybe see if there's room to make the rents go up, or what it takes to get a little bit, an infusion of capital. Does that help us get more rent? And so by the end of the 6 months, hopefully we'll have a stronger rental pool. And also we can, use the appraised value, because, a lot of these multifamilies go off, what does the property generate? So we go in there, fix them up, bump up the rent a little bit, and then we can go to our lender and do a rate and term refi on the appraised value, not the acquisition price.
There you go. Boom, boom.
Yep.
And also just keep in mind, there's with everything going on these days, I think the news just came out that it got a little bit harder to borrow on a conventional level. I mean, for everybody probably, because it's requiring more reserves, but also if you're self-employed, right?
Yep.
We're
And
in the middle of 2 refinances right now on some fourplexes, and actually they don't require seasoning. So there are banks, local, regional banks, credit unions that don't have that requirement that Matt's talking about. The bank that we're working with right now doesn't require that. And, but they, like you said, they are requiring significant cash reserves. And sometimes I've heard up to 4 to 6 points. 6 points was the highest that I've heard from Chase, quoted to one of my clients for a cash out refinance.
Wow. Yeah. What's also fantastic about plugging in and working with you guys is that you yourself are investors, and you're dealing with all these different investors all these times. And you're also seeing, it's not like it's bad news if your loans get paid off. They're meant to be paid off at a certain point, right? With conventional financing, ideally, or so of some sort. And so, I'm sure you guys are well informed of which are the great banks, that can do this takeout financing and stuff like that. And that's another reason just to network with you and be plugged into, everything that Flynn Family Lending has to offer. Good. I mean,
it's nice because we like to help people structure their purchases or transactions. So there's many different ways of doing it. And so we look at all aspects from start to finish. So if there's a way we can help you structure your deal, so you make sure that your end product or your exit strategy is played the best and you optimize every opportunity, then we like to help people do that. So that way it's a win-win for everybody.
Good stuff. So how can everybody reach you guys? Get ready to wrap up here. And, how can people plug in, whether they want to be a borrower or they want to be maybe a private lender, and talk to you guys about that?
Well, they can check out our website at flynnfamilylending.com. We're also on Facebook and Instagram and LinkedIn. You can reach Matt at flynnfamilylending.com.
Or Beth at flynnfamily.com.
Do you guys have
I call him our chief creative deal maker. I'm more of your back office operations gal.
But we know who's in charge. It's okay.
That's right. Yeah. Well, as we wrap it up here, what do you guys do for fun outside of being so busy at work? What do you guys do?
Well, we have 3 kids, so we have a full-time second job with our family. That's what we like to spend the majority of our time with our kids and our parents. So we're both pretty family-oriented, but, I love to golf and, play poker. So I'm always looking at those options, hint, hint.
Well, I've noticed, Matt, that you're not that bad of a dancer. You're getting a little better on the TikTok dances.
Yeah, doing a lot of TikTok with the kids. I got to tell you, COVID, I think it's been awesome. It's given us a lot of time with our kids, a lot of time with our family. So, it's just how you manage things. So to us, great to have more time with our family and our kids, as work stuff a little bit, maybe a little bit, but the all in all, I choose our family all day long. So I'm okay with how things are playing out so far.
Yeah. And, we have a long road ahead of us. I think we're just here at the tip of the iceberg right now. So
Yeah.
we'll have this conversation again, I'm sure, in another 6 months or so. Check back in, see how things are going. We'd love to have you guys on. You're a great resource to plug into, our local market here in the Seattle area, the Pacific Northwest. See how things are going. So as your borrower activity, are you guys finding, sorry, now I thought of one more thing to ask you before we get out of here. Are you finding that you're getting like, I need some help to be saved because I'm in a situation due to all this right now? Or are you getting calls on new purchases?
A little bit of both. In March, I think it was help me save my deal. My lender backed out and I've got non-refundable earnest money on the line. And then in April, it was, hey, how high of leverage can I get from you? Because all of the 85, 90% loan to value or loan to cost loans disappeared. And so they were just checking out their options. And now that things have stabilized a little bit and people are still seeing some positive aspects to the real estate market, we're getting a lot of purchases coming our way, and they're coming from the right people. Those that have some cash reserves, they've either got money to support part of their down payment or support their rehab, and there needs to be some sort of skin in the game, or pony up some properties as collateral to leverage that equity, as Matt was saying. So they have to have one of those combinations. This is not necessarily a time for newbies to start out. And so they're not really knocking on our doors, but all of the ones that have some experience and have some cash to play with or some real estate to play with are coming to us with some pretty solid deals out there.
Yep.
That's good stuff right there. So we'll check back in. How about though with businesses? Are these businesses are going through all these troubles right now. Are you getting any extra business calls for, operating capital loans or anything like that?
We actually haven't. I mentioned the one that we closed a few weeks back. But I think that a lot of small business owners are taking advantage of the payroll protection program loans and the EIDL loans.
Right.
With the second round of funding, there are still funds available through the SBA, and that's going to be your cheapest means of cash, right? And we tell that even to real estate investors. I mean, if you can go out there and find a HELOC, by all means, go get a HELOC on your property. Although I will say it's quite a bit more expensive now, as I mentioned, 4 to 6 points or sometimes lower than that. But we'll always encourage people to find the cheapest cash available to them. And then we'll be there as a backup in case they, really need some help and they need to move quickly.
Right. And then one thing I love about you guys and all our lending friends here with Seattle Investors Club and is that you use the word not competition, but co-opetition. I haven't heard that one. Right. What does that mean when you said that?
Well, it means that we have developed some pretty solid relationships with local and regional hard money lenders in the area. And because we positioned ourselves as a small family operated private lending business, that only deals in Washington and specializes in second liens, I think a lot of these hard money lenders and private lenders have recognized that we can help them close their deals too. That's why we have good relationships with mortgage brokers and real estate brokers also, in that when they're in a pinch, we can help step in and provide that second lien position loan on existing real estate. And so we've worked with companies like Certain and Civic and Merchants and Interest Funding, where they've all provided some recommendations and referrals to us. And on times when we have clients that need higher leverage and we can't support them, then we'll throw that over the fence to one of our friendly lenders too.
All good stuff, guys. That's what I love about our local investing and our real estate community here. My coined phrase is collaboration equals confidence. And just knowing that you guys are out there and available for all of us, I think gives us all a bit more confidence to move forward and continuing with our real estate investing business or our businesses or whatever it may be. So we appreciate your time today. I hope you guys are able to get outside this week and enjoy. Hopefully it'll stop raining out here. I think we're looking forward to that pretty soon. Sure would love to get my kids, your kids, all our dogs and everybody else up onto some lake and some hike. We should probably do that. Make a plan to get together. That'd be fun. How old are your kids?
Definitely do that.
Love the idea. And thank you, Julie. You got what you do, and your platform is awesome. It's so nice to be able to reach out to people like yourself or your platform and learn, get educated, get as much knowledge as possible. Back when, not too long ago, we didn't have these platforms. You had to kind of stumble and fall and try to figure it out. Now with the resources like yourself and us and, all these tools available, it's sure making things a lot easier and a lot informative to move forward and succeed. So thank you as well.
Yeah, much appreciated. And to be honest, if you guys want to plug in with us, all of you that are listening, wherever you are at, we do actually have every Thursday at 11:30 to 12:30, we have an online meetup. You can just grab the Zoom link off our Seattle Investors Club page on meetup.com. Every Thursday morning, grab that link and join us. And happy to say that usually Matt or Beth or Urkel or one of those people are usually with us, not all the time, but many times. And you can come on and talk to them directly yourself right there and collaborate with us as a group as we navigate the changes that are going on in the real estate market, or just any of the hot topics that are affecting all of us these days. It's been really, really, it's actually, like you said, Matt, it's been a silver lining with all this pandemic and health crisis stuff is that we went online for our meetup, and it's just been an overwhelming success with so many more people being able to engage. I'm probably going to stick to that even after this is all forward. Of course, we want to get back together in person with everybody, but it has been a very, very valuable platform for people to get together weekly and have their questions answered, real time every week, and for us to share so many different resources that all of us, not just myself and Joe and you guys, but everybody that joins us has been sharing some really fabulous resources, whether it goes with rental assistance or anything that is helping us move forward these days. So thanks for joining us as well on Thursdays when you guys can make it. And other than that, we'll wrap it up. And Joseph, where can everybody find the details of today's podcast?
Yeah, all the show notes can be found at seattleinvestorsclub.com/122. That's seattleinvestorsclub.com/122 with all the links and everything that we've talked about. And if you guys wouldn't mind, we'd love for you to give us a review on whichever platform you're listening or watching this on.
Good stuff. And don't forget to go back and listen to podcast number 88, where we got the history of Beth, which is also good and fun to listen to, as well as some additional information all about Flynn Family Lending. We're going to have these guys on from time to time, and we look forward to seeing you all online, I guess, until we get out of this thing. And thanks for joining us.
Awesome. Right. Thank you, too. Really appreciate it. Thanks very much.
Good stuff. Thanks, Matt. Beth, see you later.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.